So again, I'm Matthew Burke. I'm an engagement partner here at Cerini Associates who works with the audit department, mostly with nonprofit organizations and similar ones that function that way. So today, my goal here is to educate you about some more recent accounting standards updates that are out there. There's nothing really brand new. So a lot of this will be regurgitation from last year when I did this and even a few years back for certain topics. So just bear with me. I'll try to get through everything. If not, it's sort of ordered in order of importance. So we'll start with the more pressing issues that I think are more troublesome and have been tripping up a lot of clients and other nonprofits that we work with. And then we'll get to the ones that are less important, less critical, and apply to fewer of you at the bottom of this. So we're going to start talking about contributions again. We'll talk about the 2025 technical agenda for FASB, Financial Accounting Standards Board. We'll talk about the recent 2024 Yellow Book update for federally funded organizations. We'll talk quickly about some auditing standards changes, numbers 142 through 149. We'll then talk about credit losses or CECL, implementation costs for cloud computing arrangements, something that's more and more prevalent these days. We'll go back to leases again, which we've been talking about for probably 5 years now. And then finally define benefit plans, which probably applies to 2 of you, something like that. So we'll dive right in. We're starting with rules for recognizing contributions, and we're doing this because it is a sore point for us. We're mostly auditors. We deal with hundreds of nonprofit organizations on an annual basis. I myself probably am responsible for 70 to 80 audits within our office, and hands down, the biggest issue that has been causing us to have error corrections and management error comments, findings, material weaknesses, all these sort of negatively connotated words and terms is accounting for contributions. So there was, I call it recent, but it is a little bit old now, Accounting Standards Update 2018-08, released by the FASB. FASB is the ones who create US GAAP. They're the ones who sit up top on their mountain and change everything for all of us, and then we're left to deal with the dust as it settles and try to implement these things. So the whole point of this was to clarify accounting for contributions and grants, which I'll put in quotes because it's not really a defined term. It's effective now. If you're a nonprofit leader or someone that's in a finance or accounting role there, you should be aware of this. You should know it well by now. If you don't, let me introduce it to you, and definitely know that you should read more about this because it does probably affect you. Many nonprofits still are unaware of this ASU and may be accounting for contributions incorrectly. And you'll see why once we start talking through this. The new guidance clarifies, or at least attempts to clarify. You'll hear the cynicism in my voice a lot as we go through this because I feel like as much as the FASB tries to clean things up, it just muddies the waters over and over again. But it's supposed to clarify the definitions of contributions and distinguish them from definitions for exchange transactions. So there's a decision tree in ASU 2018-08 that really starts with, is a transaction a contribution or is it an exchange transaction? Because contributions 2018-08 apply. Exchange transactions is revenue recognition covered by ASC 606. That's revenue from contracts with customers. That's something that came out also years ago, really upended the world and how revenue was recognized. And of course, as a sort of negative unintended consequence, it hit nonprofits. And that's really why 2018-08 came out, was to clarify that contributions are separate from ASC 606. So we have to start there. But 2018-08 provides criteria for determining if contributions are conditional or unconditional. Contributions generally are defined as unconditional transfers of cash or other assets. Could be stock, could be equipment, could even be services and in-kind things like that. Does not require the recipient to provide anything of value to the donor in return. So it's not an exchange transaction. There's nothing being exchanged. It's just a donor is giving money to an organization for its use in certain ways. The organization is not giving anything back. So an exchange is a reciprocal transfer. Both sides are getting something. Each party receives and sacrifices approximately commensurate value. Both parties agree on the amount of assets transferred in exchange for goods and services. So contribution is more one-directional. Exchange is, by its very nature, bi-directional. 2 parties involved. There's a back and forth service being provided for a fee or something like that, as opposed to a contribution where it's more altruistic. Money is just being given for the benefit of the organization to use in certain ways. Of course, ASU 2018 has to provide indicators to distinguish and help distinguish between a contribution and an exchange, because all of this that we're talking about is not cut and dry. It's not black and white. It's subject to interpretation. And that's where we tend to come into play when we're in the midst of our audits or consulting with our clients. They're asking us how would we interpret a contract or an agreement or a donation? Because it's not always so clear if it should be an exchange transaction or a contribution. So these indicators to distinguish the expressed intent of the donor, discretion of the provider, the donor or whoever's giving the asset, and if there's any penalties assessed, they may affect the classification, generally speaking. And to muddy it a little bit more, some transactions may involve both a contribution and an exchange component, memberships, sponsorships, things like that, where part of it is just inherently a donation and the rest is valued as an exchange where you're getting some sort of benefit back and forth. So for these types of transactions, they should be bifurcated or really split, and the contribution measured at the difference between the fair value and the consideration paid. So the example I use, if it's a membership, let's say it's $1,000 annual membership, and as part of that membership, you get $400 worth of materials and newsletters and information, something like that. The other $600 is assumed to be a contribution, and that should be accounted for both ways, split. Again, adding complexity where FASB was trying to remove complexity. The intent to exchange resources for goods or services of commensurate value indicates an exchange. That's, like I said, covered under ASC 606 revenue recognition rules, not ASU 2018-08. So always start there. Getting donation, you're getting a contract from the government agency, something like that. First step, figure out, is it covered under ASC 606 as an exchange, or is it covered under 2018-08 as a contribution? Once you figure that out, it makes things a lot easier. Provider does not receive commensurate value when transferring funds for the public benefit. So this is something important. Previously, government grants were often accounted for as exchange transactions, with the idea being that the government is responsible for these different public benefits that nonprofits are stepping in and doing instead of the government agency. 2018-08 comes out and says, no, that really doesn't count. Right? If a government agency is giving you a grant, it really is probably a contribution. And you can't say that, well, the government is benefiting because we're providing this service instead of the government or something like that, or the public is benefiting as a whole, and it's the government's responsibility to provide that public benefit. That doesn't work. It's specifically called out as something that does no longer apply, under ASU 2018-08. Penalties assessed on a recipient may affect the classification of transaction. So penalties limited to the delivery of the assets or return of unspent amounts should indicate a contribution. Now, if you have a contract with an organization or an agency and the penalties can be in excess of what they're giving you as a nonprofit organization, what you're receiving, that may indicate an exchange. So it's adding up all these different things and components to determine if the contributions or exchanges apply. 2018-08 further introduces the concept of conditions on contributions. So it's not as easy as exchange or contribution. So now that we're in the contribution alley or lane, there's other things we have to consider. There's other classifications, other labels that they can ascribe that sound the same, but they're really not. So the first one is, are there conditions or are there not conditions placed by the donor on the contributions? So conditional contributions have donor-imposed stipulations that represent barriers, another defined new word that FASB created for this. Unconditional contributions do not have those conditions, do not have those barriers. And we'll talk about each of these different labels and definitions below. So conditional contribution requires the presence of both a barrier and a right of return of the funds or release or from some obligation. Barriers may be indicated by one or more factors. Obviously, see the next page. That's where we'll get into that. Barriers on contributions may be performance related or measurable some other way. This is if a donor is demanding a certain level of service, number of service, units of output, specific outcomes, or matching requirement. They give you $1 million if you can raise a separate $1 million, something like that. Those are all considered performance-related barriers that may indicate and likely indicate conditions and contributions. Limited discretion by the recipient, the nonprofit getting the money, on the activity conducted. So if the donor imposes strict requirements to follow specific guidelines, for instance, expenses have to be spent, this is a common one, in line with strict budgets, whether there's needs for approval for changes to spending, et cetera, those are indicative of barriers to overcome and possible conditions. So the most common government grant, even more foundation grants these days, tend to be expense-based. You'll submit a budget to an organization that's funding you. It may be very detailed, it may not be, but if it's very detailed and the provider of the funds is buying off on that, signing it into the contract, chances are adhering to that budget constitutes a barrier, which further constitutes a condition on the contribution. And I'll bring it home later why a condition matters. Stipulations related to the agreement's purpose, also indicative of a barrier. Requirement to provide specific services or outputs. So it all kind of sounds similar. But the whole point here is that if the donors are really imposing strict requirements on you as part of what you have to do to be entitled to the funds and keep them and use them, that's probably a barrier, which probably leads to a condition on the contribution. Reporting requirements alone are not considered barriers. If you get a grant for a year and it says, just show us at the end of the year how you spent the funds and what you accomplished, that's not really a barrier. That's more of an administrative burden. It's a requirement. So again, there's blurriness there. What's just administrative requirement and really not material to the overall contract or funds that you're receiving? What further goes on to become a barrier or a condition? There's no great answer there. The moral of the story here over and over again is read as much as you can, reach out to organizations like us who work with nonprofits and deal with this every day. Judgment is involved. Sometimes you could go either way on these things. You just want to make an informed decision when you're accounting for funds that you're receiving when they're contributions. So the other side, besides barrier, everything up here was barrier related, right? What I highlighted. Now, there also has to be a right of return or release. So this might be implied by the nature of the agreement, type of the asset transfer. It's usually specifically written. You're not using the funds properly in accordance with the terms of the grant or the contract, it shall be recouped, recovered, refunded, whatever RE word they want to use, returned. That shows that also indicative of a condition on the spending of the funds and the donation. So this is why it matters. Conditional contributions are accounted for as refundable advances or unearned contribution liabilities. So until you meet these barriers, you overcome these barriers, and you overcome these conditions, you don't recognize this as income in your financial statements. Try not to say revenue, because revenue I tend to leave for the ASC 606 exchange transactions. So you wouldn't record the contributions as contributions until you meet these conditions. So when the barriers are overcome, typically to the extent that expenses have been allocated to a grant or contribution for those budget-based ones, that's when you record the revenue. This is hands down the biggest source of adjustments we've had in our audits, probably the past 3 or so years. This is what leads us to material weaknesses in our management letters. This is what leads organizations to be unhappy with some of the findings that they're getting. And this is our platform really to educate and inform everybody all together. And we can do it individually for individual clients. And we encourage everybody to reach out to us. If you're getting sort of funkily worded donations, let us help you interpret them during the course of the year instead of just when we're coming in to do the audit at the end. So we can avoid that. We're here to help you, really, not to ding you with issues. But this is the biggest one that we see over and over again. Income being recorded before it should be, because there's conditions attached to contributions that nonprofits are not fully aware of because they're not following these accounting standards updates when they're coming out, unfortunately. And honestly, I don't blame you, because there's a lot here. It's very muddy, as I've said multiple times. And the rules do seem to change every 3 to 4 or 5 years, which sort of defeats the purpose of them when they're coming out, right? But pay attention to this. It's very important. So how do you really respond to this? And how do you deal with it? The first one I think is important. Donors have no idea about these rules. They don't care. They're just trying to fulfill their own missions. They're trying to be altruistic. They're trying to give you funds. They're trying to fund programs. They're also trying to protect themselves with the verbiage that's in these contracts that they're signing with you. There's a lot of attorneys involved who don't know about the accounting rules, nor really should they. So clarifying the intent directly with the donors is very important and very useful. That's the best way to really understand what the donors mean when they're giving you these 15-page documents that they're probably not fully reading, right? So if ambiguity can't be resolved there with the donors by reaching out to them, if they're not going to be helpful or responsive, which we see sometimes, it's always safer and more conservative to presume the contribution is conditional. Hang it up as a liability until you're sure that you meet those conditions and you can recognize it as income. The use of the term grant can be very misleading. As of right now, FASB doesn't really define grant. And I know in nonprofit parlance, it's used differently, by different organizations. Some people think grants are just provided by government agencies. Foundations provide grants too. Corporations may provide grants. Individuals may provide grants. And they all may mean something different when they use the word grant. So it's important. Accounting regulations don't define this word. That's why we put it in quotes here. So the terms of each grant, really what's written in the grant contract, whatever grant means to them, is determining how the accounting should be treated. So a grant could be a straight contribution with no conditions. A grant could be an exchange transaction subject to revenue recognition rules and not a contribution at all. So just because a foundation may give you something that says grant, that word in and of itself does not mean unconditional contribution, conditional contribution, or exchange transaction. It has nothing to do with how you account for it. So just throw it out. It doesn't matter. You have to read the contract you're getting, the grant agreement, the award letter, whatever you want to call it, to make sure you understand how it should be accounted for. So grants of all types can be accounted for as conditional, unconditional, or as revenue, strict revenue. Let's take it a step further now. Remember, we started exchange versus contribution. Now that we're in contribution land, it's either conditional or unconditional. So we just dealt with conditional. Now we're in the unconditional lane, which has more wrinkles attached or associated with it. Unconditional contributions can have donor-imposed restrictions. The word restriction sounds like condition, right? If you look it up in a dictionary, it's probably a similar definition. FASB doesn't think so. They made them mean two separate different things, unfortunately. So restrictions should be recognized as net assets with or without donor restrictions, right? If there's a restriction on your contribution, that will be recorded as revenue if it's unconditional. Unconditional contributions are recognized up front, conditional or not. So remember, we're unconditional now. If there's a restriction, you still recognize the contribution up front, but you may have to label it as restricted in the financial statements, in your net assets, in your statement of activities, in your notes disclosures in the back where you describe those restrictions. Restrictions limit the use of the contribution to a specific purpose or time period, but they lack the required elements of conditions. So the way I try to describe this is they're less burdensome than conditions. They probably sometimes lack that right of return. They give you as the nonprofit recipient more latitude over the use of the funds. So it might be a general framework of a budget. If you're getting a $100,000 grant or contract or unconditional contribution that's restricted, it could be for a specific program, whereas if it's a condition, they might tell you exactly how to spend it on that program. And if you don't spend the funds, it has to be reverted back. So again, it's hard. It's not easy to distinguish these things. You have to really read everything carefully and sometimes make judgment calls about that. But unconditional contributions without donor-imposed restrictions, those are the easy ones. That's when I just say, here, I'm giving you $10,000, do whatever you want, as long as it's in furtherance of your mission. That's unconditional. There's no restriction there. You record that as income right away, and it flows down to net assets without donor restrictions, thankfully. Those are the best to get, obviously, because you can use them however you want to help the organization, but also, in part, because you don't have all the accounting nonsense to deal with here. It's pretty straightforward. So here again, how are restrictions different from conditions? Restrictions limit the use of the contribution, generally speaking, to a specific purpose and or time. So it might be an overall program. It might be for a capital campaign, but it's not so limiting that you have to use it in a very specific way. Conditions affect the recipient's entitlement to the contribution, right? So the condition will prevent you from receiving the funds or earning the funds, and you have to give them back because of that right of return or release. Take it a step further, a contribution can also, of course, be both conditional and restricted. So hopefully you don't have these, but it does happen, unfortunately. So talking more about restrictions here. Restrictions as to time. Funding is to be used in future periods for general operating expenses. So these are pledges, generally speaking. You may receive a 3-year pledge, let's say $100,000 a year, with no other limitations on the use of the funds. That would be presumed to be a time restriction for $100,000 this year, next year, and then the year after. Those are seen as multi-year pledges. Time could just be for use in a future period. So that'll show up as income now, but it'll also be shown as restricted on your balance sheet, on your income statement, and in the notes disclosures. So whoever is reading your financial statements knows, hey, we got this contribution, but we can't just use it for wherever we want. It's set aside, it's segregated, it's restricted, and here's why. Restrictions for purpose are more commonplace. Seeing this more and more these days as donors are trying to be more targeted with what they're giving. We're seeing fewer dollars be truly unconditional, which isn't great for nonprofits because sometimes you just need cash infusion to help bolster your balance sheet, to help offset losses in other programs. So it's tough when you're getting so many dollars that are limited to specific programs. It's obviously great and helpful, but it's not as good as just pure unrestricted, unconditional dollars. So funding to be used for a specific program, but you have more control over the spending. Typically, no budgets or very light budgets. It may say if it's $100,000 grant, $80,000 on salaries and $20,000 on everything else. It's not by position. It's not by person. They usually don't have requirements for budget modification approvals and things like that. But again, it's a balancing act, and there is interpretation that comes into play. So that's the summary of the accounting for one, starting with exchange versus condition, and then two, exchange versus contribution, and then two, once you're a contribution, condition or unconditioned, and then three, if you're unconditioned, restricted, non-restricted. It is a decision tree. You'll see it in 2018-08. It sort of cascades down, and that's the best way to think about it and look at it. Of course, there's additional disclosure requirements that came into play from ASU 2018-08. You have to disclose contributions by asset type. Usually it's just cash, right? But sometimes you may get stock, donated stock. I know a lot of donors like to do that because they don't have to pay capital gains on the sort of inflated stock that they're giving you. They get a full donation for that. And you as a nonprofit usually liquidate it and take the cash, but sometimes you hold it. But if there was significant other things being donated to you, cash, securities, fixed assets, things like that, that would have to be disclosed. Donor imposed restrictions have to be disclosed in the financial statements. Again, within materiality. If you have $1 million of restrictions, you don't have to disclose every $200 that's restricted, but sort of encapsulate things into different categories. So the reader of the financial statements understands what those restrictions are, when they might be released, and what they relate to. For conditional contributions, the description of nature and amounts. So you may have dollars sitting as liabilities at the end of the year because conditions haven't been met yet. You would want to disclose that so that readers of the financial statements know what those conditions are, when they'll probably be met, and when that liability will flip into income. We see this with a lot of clients too that have a lot of, without realizing it, they have deferred income that are conditional contributions that you want to describe why that is, and that it is a liability, but it's not a debt in a sense. It's not loaned to you from somebody. It's just you have to sort of perform certain things to be entitled to those dollars, and they'll flip into income from abilities. And then qualitative information, expectation for satisfying conditions. If you have conditions that you don't think you'll ever meet, probably want to disclose that because that money won't flip into income. It'll probably be returned to the funder. If you know you're returning dollars to the funder, disclose that too. And then expected timeline for revenue. It says revenue, it shouldn't. I caught myself as I'm doing this for contribution recognition. We don't want to say revenue here because this is contributions. So I'll pause there for a breather and a water break. And reiterate, this is the biggest change that has faced nonprofit accounting in the past 5 years, I would say. And it's the one that keeps creeping up, the one that we keep seeing people not fully understanding. That's okay. We're here to help you. But please reach out to us. We can help you along the way as you're getting award letters, contracts, grants, donations. We can help you interpret them in real time. For resources beyond us or this presentation, I guess, look at our website. There's a lot of materials on there. We've done a specific one on 2018-08. My partner, Manos Cavalluzzi, has performed that. We've done trainings for our staff. We've done trainings for our clients. There's a lot out there on this because it is something that is important to the nonprofit world. That's why I spent so much time on it. So now we'll start flipping ahead to things that are, I guess, not less relevant, but less timely and not as important, I would say, and not as practical. So the FASB has a technical agenda where they sort of outline future items that they think may need an accounting change. And they start talking about it, and it's probably a 3 to 5 year process before they start talking about things before it becomes an ASU that we have to deal with. That 2018-08 is an example. That started out and was issued in 2018, didn't take effect right away, and now we're still talking about it 7 years later. So the two that I think are most relevant to nonprofits, the first one, software costs. Nonprofits, like everybody, investing in software platforms, software development, shelf packages, but sometimes they have to be customized and modified, and there's work that has to go into that. So there's certain costs related to this software development or implementation that should be capitalized as an asset and depreciated or amortized over time, over the life of the useful life of that software. So this is something that obviously, as more is becoming cloud-based and software is just getting crazier and crazier out there, and AI is taking over the world, apparently, technology is important to nonprofits. Nonprofit is not just a stodgy old business segment anymore. So I think it's important that you realize that there are accounting rules that affect how you account for the technology purchases that you're making. I think that's the takeaway here. So if you do have software development going on, whether it's something you're doing in coding internally, which probably few of you are, more likely they're working with a software provider like a Salesforce or something like that, Sage, and there's some upfront costs and implementation and training fees. Just realize that you may have to capitalize some of that and account for it differently than just straight expensing it when you're paying it out. But still, there's probably more coming down the pike from the FASB about this to clarify in the next couple of years how they want this accounted for real. Then government grants accounting. We just got through talking about government grants, and here we are again talking about changing those rules. So this is why I'm so cynical. There's some discussions about changing how government grants may be accounted for, maybe carving that out or further clarifying the contribution rules and the revenue recognition rules that we just talked about. So stay tuned on this. I don't want to go too deep into it now because it is brand new, right? Or it's not even real yet. It's just something they're talking about. But this will be interesting to watch and to see if they the FASB undoes anything that they've done in the past or just throws more mud into the pit, as they tend to do. 2024 Yellow Book. So Yellow Book is sort of becoming an antiquated term. There's uniform guidance audits that are a requirement. It used to be called a single audit, or still kind of is. Before that, it was an actual Yellow Book that had all these federal regulations. So this is if you're receiving and spending federal dollars on an annual basis. You may be subject to certain auditing requirements, but you're definitely subject to compliance requirements that's written into your contracts there. Also written into this Yellow Book. So every so often the Yellow Book is revised. 2024 supersedes the 2018. So there you go, 6 years. We might be talking about this again in 5 years. There weren't major revisions that affect you as nonprofit organizations. There is a lot of hand slapping of CPA firms that are performing these single audits that probably shouldn't be, because it's very complicated work. It's very compliance driven. It's very specialized. And if they're doing 1 or 2 of them a year, chances are they're not doing it right. So the takeaway here is, and this isn't a shameless self-promotion, but you want to work with a CPA firm that really understands the federal regulations, that performs a lot of these uniform guidance audits, because they're doing the right thing. And these are not fun. They're not fun for us. They're not fun for you, because a lot of materiality goes out the door. It's very compliance driven, making sure that you're complying with the contractual terms and this Yellow Book. The only major change that could be impactful is it increased the audit threshold from $750,000 of federal expenditures in a given year, or loan balance that you get from them, to $1 million, beginning for this year, calendar 2025. So that should provide some relief to smaller organizations that didn't receive millions upon millions of federal dollars. But if you did receive millions upon millions of federal dollars, not a whole lot changes there. Every year there's an update to the compliance supplement that says what the federal programs are, what's new, what's old, what's falling off the table, and what you as a recipient of federal funds has to do to comply, and what the auditors have to do to make sure you comply. So just check that out if it applies to you. Also, some standards changes to the auditing standards that we as your auditors would have to follow. This is from the AICPA, the American Institute of CPAs. They issue SASs, statements on auditing standards. So there's a whole slew of new ones here. Again, not a huge change for you organizationally, but it could lead to more annoying questions from your auditors, who are already annoying to you at the end of the year, because that's really what we're paid to do. So no significant outward changes to reporting. It's more about audit procedures. So there's an enhanced focus on audit risk. You'll notice now in presentations, at least that we make, we tell you, the nonprofit organization, what the risks are in the audit, where we're spending more time and why. And this is part of the reason we're doing it, because we have to tell you that now. Evaluating risks. So placing a greater emphasis on audit evidence, especially with respect to the use of technology. It's why we look at the IT control environment to make sure there's no glaring weaknesses there. It's why we may report to you if you don't have certain cyber safeguards in place that you should, because it all does come back to potentially damaging your data, potentially damaging the information that your auditors are looking at, things like that. So really not a lot to note here. Just know it's out there. There are auditing standards that change from time to time. Sometimes the verbiage in the audit opinion changes, and it's almost always forced on us. So if you see something different, don't assume we're doing something different, or your auditors, if it's not us, are doing something different. Chances are it's a response to a required change from these SASs, statements on auditing standards. Accounting for credit losses. This one is also relatively new. It applies now, but you have heard me talk about this for the past few years. The general gist of this is that we're moving or have moved to this current expected credit loss. We love acronyms in accounting. CECL is what it's called. The CECL model requires the measurement of expected credit losses for financial assets. Think your receivables, not pledges, not contributions, not rents. That's all specifically excluded. Receivables from services provided, receivables from loans you may have made, and things like that. You have to basically assess the potential for bad debts there, credit losses there, based on history, prospective information, and things like that. The prior model was an incurred loss model, meaning when you became aware of a loss, you have to book it. If a foundation, well, I shouldn't use foundation. If a provider that owes you money went bankrupt or something, you would take that off as a bad debt because the likelihood of collecting is very low, right? That was your obligation in the past. Now it's beyond that. It's that plus you have to look at your past history of losses. Maybe set aside general reserves in the future based on what you think may become a bad debt in the future based on all different factors that we'll gloss over. We don't think we have to beat this up too much. It doesn't practically have a huge effect on you unless you're a nonprofit that does lending. There's a lot of affordable housing and lending-based nonprofits that get funds from outside investors or lenders or the federal government or state governments, city governments, whatever, and loan that out to qualified low or moderate income people. For you, you're sort of functioning as a financial institution, almost bank-like. Banks are what CECL was created for, to make sure that their bad debt loss models were conservative and fair, and they weren't hiding bad loans on their books. So if you're that type of organization, this applies much more forcefully to you. It's something you have to take seriously and look at and make sure that you're following the current standard instead of the old incurred loss standard. But again, to reiterate, for most of you, this probably doesn't apply. You may just have government funds receivable. If they're contributions, doesn't apply to this. Totally different factor. So the different information that you use to develop these credit loss models and bad debt estimates, the borrower's financial condition. Again, think of this as a bank, right? If those who are borrowing from you are in financial distress, they're delinquent on their loans. If you're going into foreclosure proceedings, things like that, that indicates a higher likelihood of a loss on the loan. That should build into your model. Remaining payment terms, the volume of the assets, value of collateral, lending policies and procedures, your experience at management with dealing with this type of thing, environmental factors. So there's a lot that goes into play here. Again, it probably doesn't apply to most of you in a real direct way. You will notice in your financial statements, though, your auditors are doing the right thing, that in your financial accounting policy note, it should say you're complying with this new standard when it comes to credit losses. And if you have bad debt reserves, it should comply with this. It should be disclosed, and that should all be for the reader of the financial statements to see. And then disclosures, enhanced disclosures. It says by portfolio segment. Throw that out for now. Again, that's if you're more of a lending type organization. But how are your loss estimates developed? That should be a policy note. Your accounting policies and procedures and methodology to estimate the allowance for credit losses, your bad debt reserves, like I said, should be a policy note. A lot of this has to be in your notes disclosures. So if you're someone who reviews and reads financial statements provided to you, make sure this is in there because it should be. This just clarifies. So what happens is this came out in 2016, CECL, and then for years later, 2018, 2019, FASB has to go back and continuously provide guidance, modify it, and tweak it to make sure people really understand who this does and does not apply to. In 2018, they said operating leases are not a part of this. That's a separate standard. And then more amendments to clarify and improve areas. So if you're looking up CECL, you're going to see a bunch of ASUs related to it. That's why we put it in here, just to know that. If you plan on researching this yourself, there's a lot to it and more here. But don't worry about that too much. Cloud computing arrangements. This is important, I think, because like I mentioned, everything is going to the cloud now. Using your own servers, your physical file servers is becoming less and less likely these days. You have Azure out there, you have Amazon Web Services hosting everything for a lot of organizations and companies. And then there's, the Salesforces of the world, which is a cloud-based CRM. There's so much out there that FASB in 2018 issued an ASU to talk about the implementation costs incurred by a customer, you, the organization, buying the cloud computing arrangement. It also has a service contract. So this applies to implementation costs incurred in a hosting arrangement that is a service contract. So you don't have possession of the software. That's what this cloud is. It's floating above our heads, right? It's not ours. It's somewhere else, hosted by a much larger company. So there's internal use software guidance, been around forever and updated slowly over time to try to be more real time with what's going on in software these days, which it's hard to keep up because it changes so quickly. But in any event, there's certain implementation costs that should be capitalized after it reaches a certain point of, I think, technological feasibility. So again, the takeaway here is if you have a cloud computing arrangement, especially a new one, where you're moving things into the cloud and you're incurring costs as part of that before or during you have your service contract with the software or cloud provider, just know, let the little flag go up in your head that you might have to account for some of those upfront costs as assets to be amortized over the term of that arrangement that you have in place. And as with anything, reach out to us if you have this. We're happy to help you interpret it. Lease standards, this is getting old now. I mean, this came out in 2016. This is probably something we dealt with 2 or 3 years ago. Still seeing organizations not properly follow this. It's why we're leaving it in here. The moral of the story here, I don't think I need to go through all 8 pages of it, is that what used to be an operating lease where you just record an expense when you're making payments, or the straight lining over the life of the lease has changed. You now have to account for a right of use asset and a lease liability that tend to offset close to 1-to-1 based on the future payments that you're making pursuant to the lease discounted to present value, plus or minus certain things that you incur as part of the lease upfront during the duration of the lease. So asset and liability for leases now, instead of just straight expense in the past, and some asset liability accounting. So this is running through the lease contract terms and things like that. It applies substantially to all leases. There's still a distinction between operating and finance leases, which is the old standard capital leases, because there is different recognition involved for them. So you still have to go through that 5-step process of, is this a finance lease? Is this an operating lease? Even though they all get accounted for as assets and liabilities. There are some, that's what this says here. So here's the 5 criteria for operating versus finance lease. Does the ownership transfer? Like if you're leasing a car and it automatically transfers over to you. Is there a purchase option? Is the lease term a major part of the asset's remaining economic life? These are similar to the past, 5-step capital versus operating lease determination factors. So this is the accounting. Liability generally equals the present value of unpaid lease payments, as I mentioned. The asset upfront equals the lease liability plus any initial direct costs plus prepaid lease payments minus any incentives you may have received. The asset is then amortized over time, sort of like depreciation, because it's usually a physical asset, usually for operating leases. The liability is amortized over time, as if it's a debt that you're paying down, an interest component, a principal component that reduces the liability. And like I said, those numbers tend to offset. The issue here is when you have covenants for debt agreements based on current ratios and things like that. These new lease liabilities can sort of screw up those calculations and ratios for you. By now, lenders should know about this. They should be able to build that into their models. You as a nonprofit should know about this too. You should already be accounting for this properly. This I won't go over. It's sort of a bit much. This is important here. Short-term leases. Lessees may elect to not recognize leases with a lease term, including optional renewal periods of 12 months or less, as long as they don't include a bargain purchase option. So what we've seen in response to this, unfortunately, accounting driving legal, is a lot of organizations and companies entering into 12-month leases to avoid having to account for this way. We have a lot of organizations that lease apartments. They rent them from someone, and then they rent them out to individuals that are engaged in mental health programs and things like that. They may have 50 leases. You don't want to run through this calculation for 50 leases. It's a big administrative burden. There is software that exists for this if you wanted to do that, but a lot of them are just saying, we're just doing 12-month leases anyway, so it doesn't really apply. So keep that in mind, and that's important. Lessors, this is important to note too. It does not significantly change this new lease standard, the way lessors account for leases. You continue to classify things basically the way they were. This reminds me of something that I want to go back to contributions now, real quick. So the rules for recognizing contributions, everything I spoke about earlier and started off and blabbed about for a half hour was about you as a nonprofit receiving contributions from a donor, a funder, a grantor, a foundation, a government institution. Some organizations give money away, and they are the donors in a sense. I actually dealt with this very recently with a client who was funding programs overseas. The rules for accounting for contributions out sort of follow the rules for accounting for contributions in. Meaning, if you're committing or pledging dollars and you have conditions that a recipient that you're giving to have to overcome before they can keep those funds, that's not an expense for you yet. It's sort of a prepaid item, prepaid expense, an asset of some kind. And then you become the donor that has to make sure that the recipient is reporting back to you how much they're spending, if they're fulfilling their obligations. And you recognize the expenses when they're meeting those conditions and overcoming those barriers. So it's the complete reverse of what you'd normally see. I just forgot about that earlier. I didn't put a slide in, but it's definitely worth noting. If you're an organization that gives money out, you have to follow this for the money that's being given out too. You can't just pick up everything on expense. An example I have is an organization gave out, just use a round number, $1 million, let's say, for their December 31st year end. They gave $1 million out to a bunch of different recipients for different programs and things like that on December 15th. These organizations didn't spend that $1 million before December 31st. It was recorded as an expense by our client, should have been recorded as some sort of prepaid asset because of these rules. And that's something that you wouldn't really think because it's not written for that type of situation. But there was later guidance that came out to clarify that, yes, it does apply for the prepaid and the expense side as well as the income and liability side. So just note that. I think I covered everything. There might be one last page on here. Defined benefit plans. This probably applies to very few of you. You know, defined benefit is a retirement plan where you have to pay out a certain benefit at the end, and there's actuarial calculations for the liability, the asset, the current expense, and things like that. So there's just some revised disclosure requirements for DB plans that is effective now that you should be aware of. It's usually something handled by your auditors, but you want to be aware of that. Auditors and actuaries are the ones who beat up the DB plans. We tend to find that the nonprofits themselves aren't always so savvy with these issues because they're kind of obscure. So here's some more obscurity added on top of that to keep in mind. But as with any of this, if you have any questions about how to account for anything related to quirky nonprofit rules, please reach out to us. We at Cerini Associates, all of us are here for you to help with anything. I'm looking at questions to make sure I didn't miss anything. Best accounting software for new nonprofit, limited funding, etc. Something reasonable, free, in-kind resources. We see a lot use QuickBooks nonprofit. It's very easy to use, very cheap. 5-minute warning. Okay. Joel, thank you. Yes, thank you. So the next one here, I'm going to end this right now. It's 12:15. The NFP panel is next. Stay on for that. Get a lot of good guidance from a lot of good people in the nonprofit world. Take care. Thanks, everybody. Bye.